Welcome back, everyone. We are moving right along in our ASC 360 Property, Plant, and Equipment training. In our last lesson, we tackled the heavy lifting of construction costs, interest capitalization, and asset retirement obligations. Now, we're transitioning into a really critical and, honestly, pretty fascinating phase of the asset lifecycle, post-recognition measurement. Let's get right to it.
Here is the roadmap for this explainer. First, the purpose of depreciation. Second, the 4 methods of depreciation. Third, useful life and estimates. Fourth, impairment triggering events. And finally, the 2-step impairment process.
Section 1. Purpose of depreciation, reflecting the pattern of consumption.
Okay, let's kick things off by busting a huge myth about the business's usual side of accounting. Depreciation is the systematic allocation of an asset's depreciable amount over its useful life. Notice that crucial part at the end. It reflects consumption, not market value. I want to strongly contrast the systematic cost allocation against market valuation, because a lot of people outside of accounting think depreciation tracks how much a building or a machine could sell for on the open market today. It absolutely does not. Depreciation is just the planned, mathematical consumption of an asset's economic engine over time.
Section 2. 4 methods of depreciation, the accounting toolkit.
Now, what's really fascinating here is how we actually match the math to the specific behavior of the asset. Let's compare our first 2 tools. First, we have straight line. The formula is cost minus residual value divided by useful life. Simple, right? This gives you a perfectly even charge each period. It's ideal when the asset provides a steady, consistent benefit year over year. Think of an office building or basic furniture. Then we have double declining balance, or DDB for short. The formula takes the beginning book value and multiplies it by 2 divided by the useful life. This is an accelerated method. It's best when the benefits of an asset are heavily front-loaded. Think of technology equipment or fleet vehicles that lose their utility and efficiency incredibly fast in those early years. Let's put some real numbers to this to see that rapid early decline under the DDB method. Imagine we have a $120,000 asset and we're applying a 20% DDB rate over 3 years. In year 1, we take a massive $24,000 of depreciation, which drops the book value to $96,000. Then in year 2, we take 20% of that new $96,000 balance, reducing the book value to $76,800. By year 3, the book value is down to $61,440. You can really see how heavily front-loaded that expense is compared to a flat, boring straight-line charge. But wait, there is a vital mechanical catch with DDB. It's called the switch to straight-line rule. Basically, you must switch over to straight line when the straight line amount exceeds the DDB amount. I really want to emphasize this rule. See, as the DDB expense gets smaller and smaller each year because you're multiplying a fixed rate against a shrinking book value, eventually the straight line calculation over the remaining useful life will actually give you a larger number. When you hit that crossing point, boom, you make the switch to straight line to finish out the asset's life.
Let's contrast our final 2 methods. First up is sum of the year's digits. Like DDB, this is an accelerated method, but it forces a much more gradual decline using a fraction of the asset's remaining life rather than a flat percentage. Then we have units of production. Here you calculate depreciation per unit of output and multiply it by the actual units produced. What's absolutely crucial to understand here is why something like heavy mining equipment uses units of production. The wear and tear is tied directly to what it physically produces, not the calendar. So if the factory shuts down and there is 0 production, you record 0 depreciation for that period. Makes sense?
Section 3. Useful life and estimates. The crystal ball. Let's take a look into our crystal ball and see how we actually estimate useful life and residual value in the real world. This beautifully illustrates the massive range of expectations across different asset categories. At the very top, we have land. Land has an indefinite useful life, so it is never depreciated at all. Below that, buildings sit comfortably at 20 to 40 years. But check out the bottom row. Computer and IT equipment has a remarkably short life of just 3 to 5 years. Why so short? Because of swift technological obsolescence. Your useful life estimate must always match the underlying economic reality of the asset.
But, what happens when reality shifts and that crystal ball gets a little blurry? Well, changes in estimate are prospective. You apply the new calculations going forward, do not restate prior periods. Let's anchor this rule because it's super important. If you realize in year 4 that your 10-year machine is actually only going to last 7 years total, you just course correct prospectively. You take the remaining carrying amount, divided by the revised remaining useful life, and move on. You never ever go back and rewrite history to adjust prior financial statements.
Section 4. Impairment triggering events. The reality check. The tone really shifts right here.
We're moving away from routine, systematic planning into what happens when things suddenly go wrong. Impairment testing is not an annual chore. It is triggered only by specific events or changes in circumstances. So the biggest takeaway here is that impairment testing under ASC 360 is strictly reactionary. It's literally an emergency alarm tripped by specific events out in the wild. You don't just schedule this on your calendar every year like a routine inventory count.
Let's quickly run through the 6 warning signs that actually trip that alarm. Number 1, a significant decline in market value. Number 2, an adverse change in use. Imagine a manufacturing line that gets permanently shut down. That brings an adverse change in use to life immediately. Then we have an adverse change in the business climate. Construction costs significantly exceeding the budget. A forecast of continuous operating losses for an asset group. And finally, sudden technology obsolescence. If any of these hit, the alarm is sounding and you must test for impairment.
Section 5. Two-step impairment process, the measurement.
So, the alarm is ringing. Now we have to strictly apply a two-step test to see the extent of the damage. Here is exactly how that works. Step 1 is the recoverability test. You compare the asset's carrying amount to its undiscounted future cash flows. If the carrying amount is less than or equal to those cash flows, you're fine. You stop right there. No impairment. Step 1 is really just a threshold test. But if the carrying amount is greater, you fail Step 1 and you have to proceed to Step 2. Step 2 is where we actually measure the loss. We write down the carrying amount to its fair value. Notice the difference? Step 1 uses undiscounted cash flows, but Step 2 strictly measures against fair value.
Let's run the numbers so you can clearly see Step 1 and Step 2 separated. Say we have an asset with a carrying amount of $500,000. We look at the undiscounted future cash flows, which are projected at $420,000. Because our $500,000 carrying amount is greater than the $420,000 in cash flows, boom, we fail Step 1. Now we move to Step 2. The actual fair value of the asset is only $380,000. So we take our $500,000 carrying amount, subtract the $380,000 fair value, and we take an impairment loss of $120,000. That $380,000 fair value now becomes your brand new carrying amount for future depreciation.
Now, I need you to pay very close attention to this next part. It's the US GAAP no reversal rule. Impairment losses on assets held and used are permanent and cannot be reversed, even if conditions improve. Under US GAAP, once an asset is written down, that write-down is a harsh, permanent reality. If the market miraculously bounces back the very next year, tough luck. You do not write the asset back up. That loss is locked in forever.
Which leads us with a really fascinating question. If an asset's value drops, GAAP forces a permanent write-down. But if it bounces back, you can't write it back up. So why does US GAAP prioritize this strict conservatism over current market reality? I'm going to let you ponder that thought. Think about the underlying theories of accounting and protecting investors as we wrap up this module. I hope this explainer has illuminated the mechanics of depreciation and the crucial reality checks of impairment. Next time, we'll dive into our final lesson on disposals and presentation. Thanks for learning with me today.